Talk about the last of these generals, Tom, that are standing. Do you think it's trading on anything resembling fundamentals, or is this more of a positioning story?
Yeah, it's a great question, Carl. So on two fronts, I think about it. What you're seeing right now in technology stocks is clearly the tide is going out, and now it's starting to affect the big boats when you think about Apple and Amazon. From a fundamental standpoint, it was quite significant when Apple suggested that they would have a $4 to $8 billion negative impact in the June quarter on the shutdown of manufacturing capacity in China. By way of comparison, they had about a $6 billion impact in the December quarter. Seasonally, the December quarter, they have much larger sales. So I think it's part fundamentals and part what you're seeing with the market in general, and again, the tide going out for technology stocks.
Right. What kind of discount did you put on your model when you got that incremental information on the China expense? And I wonder, although it's purely anecdotal, Tapestry today saying they think the lockdowns might expire in June. Does that seem reasonable in the way you're looking at Apple from here on out?
Sure. So when Apple reported their March quarter, they said the good news is that the manufacturing capacity had come back online. But I think when you think about stocks in general, and you ask me about what haircut or things of that nature, what you're seeing is we're doing discounted cash flows. And in many instances, we've had to increase our discount rate by 100 basis points with the 10-year Treasury around 3%. And when you couple that with lower near-term expected sales and profits, it can have a negative impact even on Apple.
Tom, I mean, that $150 mark level, I should say, for Apple's share price was being watched so closely. We broke through that. We're now trading around 141 and change. From a technical perspective, do you expect shares to fall further in the near term, or would you be buying at these levels anyway?
Great question, Morgan. When I think about FANG in general, I think even FANG is going to continue to be under pressure. There's some very specific challenges at Amazon, at Netflix, and with Apple on the supply chain front. So from a technical standpoint, I don't know that you're going to see support in Apple shares. I think there could be more downside.
Are there other names where you'd be buying right now at these levels?
If you look at it, for example, earlier this week, more of a SMID name, but Vivid Seats reported excellent numbers. They're benefiting from pent-up demand for concerts, live events, things of that nature. I have other companies in the SMID space. I still think Roku at current levels is quite attractive on the shift from linear television advertising to over-the-top. But there's there's enough specific challenges at Apple and Amazon that have me nervous.
Speaking of your universe, Tom, actually quite a few components are trading well. You mentioned Roku, Etsy, Wayfair, Sonos today is up almost 12. How do those things feel to you right now?
Sonos is a great example of a strong on a relative basis. So they're feeling the same challenges Apple is from a supply chain standpoint, but at a company-specific level. They initially added some capacity in Malaysia when the tariffs first came out. Now they're adding manufacturing capacity in Vietnam. Their core customers showing a willingness to wait for their product and has an above-average household income, so more insulated from inflation. I think that's why you're seeing a double-digit move in Sonos today.
Yeah, all those conversations we had with Patrick Spence about migrating supply chain maybe paying off after all this time. Tom, thanks. Good to see you.